So as you know, there are only two things that are guaranteed in life: death and taxes. And I guess the safety of your US bank deposits are in a close third place. But not much else in life is. From crossing the street to going for a swim, everything you do carries risk, and so does investing. So the key to building wealth is not about avoiding risk entirely, but rather about managing it and making sure it's aligned with your goals and risk tolerance, right? Even though historic performance can't guarantee future returns, we can learn a lot about market risk from the past. So let's hop into my time machine to take a look, and then I'll end with 5 rules of managing investment risk, all right? So this is how the US stock market has grown between January 2004 and 2024. First you'll notice is that it returned about 530% total growth. So a $1,000 investment would have grown to more than $6,300, or $10,000 would have grown to $63,000. That's about 9.7% average annual compounded return. The reason I picked this time range is because I wanted to show you how the market performed in the face of 3 extreme market events that occurred in those 2 decades, and the things that many investors did that made them lose money rather than get 6 times richer. Okay? So where do you see the biggest drop? If you thought it was here, not quite. This marked the beginning of COVID, when the market dropped by 34%, but then went back up pretty rapidly after massive government interventions around the world. Then that was followed by another smaller drop on the right, which happened when that intervention led to rising inflation, including in the US. But both of these drops were brief, and actually not as big as a much deeper and longer decline hidden in plain sight. Can you see it? It happened during the Great Recession, beginning in 2008, which saw the biggest economic downturn, not just of the past 20 years, but of the past 70 years, all the way back to the Great Depression. So this is what a massive 50% slump over 18 months looks like, okay? And as you can see, it took about 5 years to recover fully. But do you notice something really surprising? It looks like nothing more than an annoying pothole on a dirt road, and sort of unremarkable looking back even 10 years later, doesn't it? And to give you a longer perspective, why don't I list some of those potholes over the past century, okay? How about 2 world wars, a depression, about 14 recessions, more wars, high inflation, deflation, civil riots and unrest, even more wars, energy crisis, terrorism, banking and financial crisis, and a pandemic that claimed more than 1 million lives. So, I don't know what the future will hold. But I wouldn't bet that the next 100 years will be much rosier than any of this. Okay? And I'm not trying to sound like a total Debbie Downer here either, only to offer a historical perspective. This is why the first cardinal and non-negotiable rule of managing risk is to only invest for the long term. So if you'll need the money in 5 years or less, stick with savings, okay? And once you're in for the long haul, tune out the market noise and swings along the way, because you can neither predict them nor control them. So how do you do that? Well, just invest like a clock. Every week or every month, whether the market is up or down, because this guarantees that you would be buying when stock prices are falling and they're available at discount, and not just when the market is going up, also called dollar cost averaging. This is how experienced long-term investors improve their returns, while new investors only get excited when the markets go up. So clockwork investing is your autopilot, and it's both simple and powerful. Third, please don't put all your eggs in one basket, okay? And diversify. If you buy stocks of only a handful of companies, or crypto, you'd be setting yourself up for a very bumpy and risky ride. But simply adding more companies to your portfolio doesn't mean you're actually diversifying, okay? Because what really matters instead is how your investments move in relation to one another. So some of your investments should zig while others zag, all right? And that's called negative or low correlation within your portfolio. The goal basically is to have investments that all grow over the long run, but don't all rise and fall at the same time. That way, the ups and downs smooth out, and your financial journey feels a lot steadier. In other words, every portfolio always needs to have losers, because today's losers can be tomorrow's winners. You just don't know when the tables will turn. Fourth, the higher the returns you're aiming for, the greater the risk and the bumpier the ride. So for instance, you already saw the historic volatility that has come with the 10% growth of the US stock market. But if you're chasing faster growth, you should expect a much wilder ride with bigger ups and downs. And on the flip side, if you want lower growth in exchange for lower risk, you can do so by diversifying into other assets, such as bonds. Because bonds have a much lower correlation with stocks and offer some stability and protection when stocks hit rough patches. So the key is finding the right balance that matches your goals, time horizon, and your comfort with risk. So for example, when you're in your 20s or 30s, you can aim for aggressive growth closer to the 10% historic average. But if you're only a decade away from retirement, you should dial it back, or you'd be risking a big market slump right when you start selling your investments at a steep loss to fund your lifestyle, right? So a good way is to think about your investment journey in two phases. Phase 1 is capital accumulation, when you can be after aggressive growth, and then you gradually phase out risk and move into a capital preservation phase with lower growth and also lower risk. All right? And finally, make sure you have enough in cash reserves at all times. You really don't want to feel pressure to sell investments for short-term needs or to make it through unplanned loss of income. And your cash reserves will also give you breathing room to tune out short-term slumps in the market, okay? So do those 5 things, and you'd be really ahead of the game without rocking the boat.